Hi, everyone. This is Bill Fairman and Wendy Sweet of Carolina Capital Management. I have picked up the energy level from our last show because I was down in the dumps.
That was really good. I'm impressed.
So our website is carolinahardmoney.com. If you are a borrower, click on the borrower tab. If you're interested in passive returns, click on the investor tab. Don't forget to like, share, and subscribe to our channel. We do take questions and comments as long as the comments are nice.
And the questions are worthy.
So you can type them into the chat. Again, I don't know what your platform, how you see them, but it could be to the right, could be to the left,
or
could be underneath.
But
there should be a place there for you to do live chat with us. So today's show, we're actually going to talk about current market. We have a great guest coming on later in the show, Aaron Chapman, good friend of ours. He's out in the Phoenix area.
Yeah.
He is an investor, single family.
He's a conventional lender for investors.
Single family investor lending.
Yeah.
But he's so much more. He has so much market knowledge. He actually is involved with a group that lobbies Congress and Senate on behalf of the private and the owner financing industry.
That's right. Yep. That's right. He's pretty awesome. And he's been on before.
Yep.
We've had him before, and we'll have him again. He's a wealth of knowledge.
He also represents the redneck community.
Yeah, in a mighty way. He's awesome. He's Duck Dynasty in a mortgage suit.
He's a great guy. He'll be on later on in the show. At the bottom of the hour,
that's
as
right.
They say.
We'll call him A.A. Ron Chapman.
So, yeah. So we were talking earlier. You were at Tom Olson's Good Success Mastermind last week. You want to go over some highlights?
we were talking about the market and what it's like throughout the country. And I have to tell you, I have been walking around this week with kind of a burn in my stomach, just a little bit concerned. It's Zantac. Yeah. It's just a little bit nerve-wracking when you really don't know what's going on. What we see is happening today. Sales are doing well. People are halfway working. We're seeing big changes going on. We just don't know what's going to happen. Interest rates are like under the ground. They're so low. We're just uncertain about what's going to happen. And, since the end of February, we could do a market update every day and it'd be completely different. Right. I've had this burning in my stomach because I'm watching unemployment continue to rise. I'm watching.
Actually, it was down today.
I'm going there. I'm watching. Let's see the unemployment. I'm watching the value of the dollar drop. I'm watching coronavirus statistics, which may or may not be true, come back higher and higher. And it's, I'm just was worried about it until I heard the radio today. And they talked about how unemployment is lowered now.
Well, it's not. Fewer people applied for.
Yeah. Unemployment is low. Yeah, that's it. Fewer people. So they were expecting it to be like 1.2 million people apply for unemployment, and it turned out to be in the lower 900,000. Mm-hmm. Woohoo! That's a big difference, but it's still a big difference. And even in our area, they're saying that the positive tests that were coming back had been averaging a little over 10% as being positive in COVID, and now it's in the very low 7s, almost 6s. So that's encouraging too. I'm really, really glad to see that. But there's so many things that we discussed in this Good Success Mastermind. There was a gentleman there in particular by the name of Eddie Wilson, who is one of the smartest guys I know. We're going to have him on. I think he's going to be on the week of the 24th, he's going to be our guest here, August 24th, I think, if that's a Thursday. But anyway, after the 24th, I know he'll be speaking. So he's going to be talking about, this is a guy who's in his 40s. And this time last year, he owned 83 businesses. So he's got a little experience in buying and selling businesses. He's heavily involved in the real estate industry, but he's got a lot of different types of industries. He does some work for the Mike Pence campaign. He's just a guy that's truly in the know. He's full of great information, and he gave a presentation that was very, very in depth with what's going on and what we can expect. And I tell you, I can't get enough of that information from the circles that we travel. And David Phelps is another person who has just been so key in drilling down what's going on in our market and what we can expect in the future. And same thing with Collective Genius, all the people that are in that group with Jason Medley. And it's just amazing to see what's going on around the country. And we get to see that, front and center. We get to see that with all our friends and hear what others are doing to protect themselves. So one of the things that we know is that if the employment situation stays in the same range that it is now, because people are still filing for unemployment. The filing might be down, but we still had 900,000 people file for unemployment. There's 900,000 jobs lost, and as the government stops printing money, because it's going to stop, they can't continue to hold up our economy. That's what they're doing. They're lifting it up and keeping it so that we're not Venezuela, out of money, Peru, out of money. People there that have money, they can't even buy food because there's no food. It's completely messed up their chain of life. So in order to keep us from being in that position, they're printing money. They're printing money so that people can pay their mortgages and pay their rent and buy food in the grocery stores. They're lifting up that economy. So it's false right now. It's being held up by two legs of a three-legged stool, and it's about to fall over as soon as they stop, because they're going to have to stop at some point. It's going to have to stop. We're going into a recession. There's no way around it. There's no way around it. The difference between a recession. We
are in a recession.
Well,
officially.
We're going into a bigger one.
Okay.
It will be officially worse. But the difference between what's happening now and what was happening in 2007, 8, 9 is it's not caused by the housing. We didn't have the housing to help us, the housing market to help us back then in the mid 2000s. We have the housing market to help us now. But what part of the housing market will it help? We've got, what sectors do we need to be concerned about? Hospitality, commercial, strip centers, retail commercial. We need to be.
Office is going to, depending on where it's located.
That's right. We've got people in one of our groups that are talking that they're going to start taking these strip centers and turning them into single family housing. I don't know how that's going to work. We're going to a meeting in a month. We'll be at our Collective Genius meeting, and I can't wait to hear and see what people are thinking about doing and what is that going to look like. But, we need to understand that that's a market that's going to hurt and it's going to affect all of us. When one person hurts, all of us are going to feel it. So we need to be prepared for it. One of the things that they were talking about too is the value of the dollar is going to drop. There's really no way around that. We've got all this monopoly money out there, and it's going to drop. So how do you fight inflation? How do you fight a recession when the value of the dollar drops? Because hoarding cash isn't going to help all that much, because the cash isn't valued at what it was. So, then we started talking about precious metals. about buying gold, about buying silver, what the cost is. And they were talking about, I thought this was really interesting. They were talking about how silver, gold has always outpaced silver as a precious metal, but that the silver is also used as an industrial metal. It's used in computers and so many other things. So proportionally, silver should increase in value more proportionally as compared to gold.
That would happen as the economy comes back.
That's right. And we're talking about real bullion, not buying it in paper, buying the real bullion and sitting on it.
Why would anybody buy precious metal certificates?
Yeah, doesn't
because
really make.
It's not worth very much.
That's right.
All right, that said, and Aaron will also talk about this.
Yeah.
But a great way to overcome inflation and to actually benefit
is to bury your head in the sand and ignore that it's there.
From inflation is that if you buy a rental property utilizing a very low interest rate mortgage,
which you can get around here,
and you get a 30-year mortgage and you're paying that mortgage with today's dollars, and further into the future, those dollars continue to be worth less.
Right.
But the house continues to go up in value and it's producing you an income.
That's right.
That's the best hedge.
That's right.
Because as much as, precious metals can be a hedge, you can't rent your precious metals.
That's right.
You can't get an income from it. The only thing you can do with it is if the economy totally does collapse, you can use it to buy stuff with.
Yeah.
You can use it as currency.
Yeah.
Or the only other way you're going to make money with it is by selling it for more than you paid for it. That's all you can do with precious metals. I'm not saying it's a bad thing to have, but I like the real estate side of it before I like the precious metal side.
Well, it doesn't have to be either or.
Because you could,
right?
When a house doesn't go up in value, rental property is what I'm talking about.
Right.
Investment real estate. When it doesn't go up in value, it still pays you an income.
That's right. Hopefully.
If it goes up in value, listen, and that's not why you buy it. You don't buy it because you want it to go up in value.
That's the cherry on top, right?
To produce income, cash flow. And if it does happen to go up in value, now not only do you have let's compare it to a growth stock that pays you a dividend. Most stocks that pay dividends are not growth stocks. They're giant blue chip kind of companies that kind of stay steady, but they pay you a dividend. They're not expected to grow because they're already behemoths, right? But if they invent something new and all of a sudden they've got new capital markets to exploit, then it will go up in value. So now you've got appreciation and you've got cash flow. So those are good things. Here's another thing that's going to ease your mind. Interest rates will remain low for quite some time. And you want to know why?
Because nobody will be able to qualify for them?
Because all your governments are in debt.
That's right.
And if they can keep the rates low, they can continue to borrow more money.
That's right.
And they don't have to pay it back at exorbitant amounts. And do you think the governments are pressuring the federal banking system to keep rates low?
Right.
So all this money they're borrowing, they don't have to pay back at exorbitant rates. Yes. Right. So the rates will stay low for a while because it's in the government's best interest to keep the rates low.
Yeah.
It's not very good for savers.
That's right.
That's why you see the stock market continue to go up, because if you put it in money markets, you're getting squat. You put it in the bond market, you're getting squat. Eventually, you're actually going backwards.
Yeah, negative. And that negative is a reality.
Again, you go into real estate that provides an income. Now, we all know that you can get an income from active appreciation and then the sale. That's what we do in the fix and flip market. The same thing can happen in commercial markets. You just got to get into one where they're redeveloping existing properties, because you're going to be able to get retail, hospitality, those types of properties a lot cheaper going forward. The the problem that I see with mortgages getting delinquent or getting battered and bruised, you're going to have a lot more companies that are going to sell the notes that are scratch and dent.
Right.
So there's opportunity there coming up. And then, yes, there's going to be foreclosures, but I see the prices of single family homes in most markets, most areas, and I'm not talking about their very high end properties. I'm talking about the properties that most people can afford. They are going to stay high because, let's face it, we're still growing as a population, and I can just about bet you that we're forming many more new households during the quarantine.
Right. Well, one of the things,
and there was already a housing shortage to begin with.
That's right. One of the things they were discussing too while I was at this meeting is we were in the state of Indiana, and I believe they were saying that they had just been told that there were already 5,000 pre-foreclosures in their system, which is they were at 10% of that previous before the COVID hit. So it's really important to understand we are going to be flooded with some foreclosures. There's going to be cheaper houses out there. So what does that mean?
Short sales.
Short sales. But do I wait to buy property thinking that, well, if I waited 2 to 3 to 4 months, our value is going to drop because there'll be more opportunity out there?
Excuse me.
Do I just throw it down? Do I wait for that? Or, am I safe to be buying property now? Am I safe to be buying property now? Well, let's think about that. If you're buying property as rental income, we've already addressed, don't think about the appreciation on it,
right,
because that's the cherry on top. You don't buy property based on the cherries, or the chocolate sauce that you're going to drip on top of it.
Right.
You need to buy it based on the income that you're earning off of it. And that's not likely to change, or it's not likely to go down. It's more likely to go up because as the foreclosures hit, now you've got these displaced families that need to find a place to live, and they're looking to rent, not buy. Mm-hmm. Right?
Yeah. And real estate is local. There's going to be markets that are going to go down in value, but it's going to be the unaffordable markets that are going to go down in value. Your affordable markets, the ones that have been maintaining affordability, are going to, and I'm not saying that there won't be a hit, but I don't think it's going to be a decline in value. It's just going to be a slowing of the appreciation.
Right.
Because there will be a little bit of a glut. It doesn't mean you're going to get them cheaper and cheaper. You're going to have to get them off market or get them through foreclosure or get them through purchasing the note. And then hopefully you can work it out with them and make some money that way. But if you have to go through the foreclosure process, then, it happens.
And it's really important too, I think, to really keep an eye on what's happening in your particular real estate market. When we order an appraisal, we're ordering appraisals based off what has sold in the past 6 months. That's what they're picking. Well, as they're doing these newer appraisals and using what's happened in the past 6 months, if the property values are dropping, if you don't really have your thumb on what's going on, those comps that they're using may have a higher value than reality. That's why we lowered our loan to value down to 65%, because we weren't sure and still are not sure what's going to happen in that market, right?
Yep.
So even though you've got these great deals going on, be careful about the percentage that you're in on these houses. Make sure you're leaving yourself plenty of room.
Right. And don't over leverage. If you're using financing, me personally, I try to stay at least 75% loan to value or less, only because we never had values drop, less than that. By the way, Jonathan is on.
No, it's Aaron.
No, I see Aaron. He's in the hold. He's in the green room right now. but Jonathan had made a couple of comments about, inflation. Right now, inflation is running about 2.4%. And I'm going to say that Aaron is going to argue with him about that because the actual inflation numbers that they produce pull out stuff that we actually use, energy for one of them. The actual inflation numbers are actually higher than what they're saying, but he's right in this aspect is that the average return on these, bonds, money markets, and that kind of thing is like 2.5%. So you're going either backwards or you're barely keeping up with inflation anyway.
Mm-hmm.
But I know Aaron's got some numbers that are hiding.
That's right. So now would be a great time
that
to
they don't
introduce
tell you about. So,
hey, Ron.
With Aaron was kind enough. He had a call earlier, and he was kind enough to join us later in the show. How you been, bud?
Not bad, man. How are you guys?
We are loving life. I just wish I was in an area like yours that didn't have near as much humidity.
Well, we're still hot as hell.
Yeah, I know.
The one thing about it is we have some of the best ACs in the world. I think only the royal family in Dubai have better ACs. So Arizonans know how to run an AC. I'll give you that.
That's awesome.
That's one of the few places that those little misting things actually work.
And they work well.
In our area of the country, all they do is make us more wet.
Swampy like.
You put that double shower in the day, right?
That's right. So, listen, thank you so much. I know conventional mortgage business is just through the roof right now, and I know you're busy as hell. Thank you so much for giving us a few minutes of your time.
Well, anytime the brother of Wendy Sweetwich reaches out, I do that because Wendy's involved. If it was just Bill Fairman and I didn't know Wendy existed, you may not have seen me today.
It's all right. When Wendy and I first started working together, we were at some event, and by the third day, I just changed my name tag. I just turned it over and wrote on the back, Wendy's brother.
Wendy's brother. Yeah, you got a lot more attention that way. Who's this guy who's following me around and talking?
That's right.
Yeah, who is this jerk? So, Aaron, other than being busy as hell, and we touched on this with real inflation numbers, you want to chime in on that? Because I know you have a lot to say about the inflation.
Oh, yeah. I get to spitting in the phone about that kind of thing when people tell me that inflation is 2%, when actually the Fed is talking that it's sub 1. Which was recent stuff because it's probably come up a little bit more than that. It's over 1% based upon what they're claiming. In fact, it's just over 1% when you look at what John Williams is producing on Shadow Stats is what the Fed's claiming. So, and I'll ask you a really, really, really heavy question here, Bill. What are the 4 things the humans need to survive?
Food, energy,
shelter.
Yeah, housing. I'm not sure about the last one.
Clothing. No,
you don't need clothes.
Clothing falls under shelter, so it's food, water, shelter, and air.
Oh
yeah, air.
Air. So California is the only state that's figured out how to tax air. Right, you pay for the weather in that state. But when it comes to those other 3 things, the Fed is not factoring the food costs, energy costs, which is basically water, right? And then they're definitely not factoring parts of housing. So we start getting into those things, considering the meat index alone is an 18% year over year inflation. We're seeing the meat index inflating by 18%, and that is the last numbers I've seen. Then when you start talking about water, what's the cost of water right now, especially if you're in California? We just talked about them taxing air. Their water costs are going through the roof everywhere. That resource is through the roof. In fact, if you watch The Big Short, it talked about Michael Burry in there, who is the one who saw this, and it's because of what he saw coming when he read the mortgages that's what produced all those people jumping in on The Big Short. Well, they said at the end of that movie, he's heavily invested in water because of how much that resource is going up. So when you think about those things and you start looking at John Williams' Shadow Stats, we're right now we're just between 8 and 10% on the national inflation. Go to the Chapwood Index. I'm going to pull it up. ChapwoodIndex.com. And that will show you the inflation based upon where a person lives. So if you're looking like Northern California, you were double digits. Like New York, its 5-year average is 11.4%. LA, 11.7. You get into San Jose, California, highest in the nation at an average of 13%. So
Wow.
The reason that I get into that and really digging deep into understanding inflation, because real estate investors who have the capability to work with me on the financing piece, that conventional 30-year fixed, you start realizing that it's no longer spending money and going to debt. When you have somebody willing to put up 80% of the capital for your investment, but says, hey, you can pay me back over 30 years. And then you come to the realization that you're not being beat to death by compound interest over 30 years. What you're getting is you're getting the ability to pay them back with a declining instrument like the dollar. We just proved that of where inflation really is. Let's say it's only 7%. It's where inflation is kept at when you average it out, because maybe you're not spending money the way most Americans do. At 7% inflation, if you're borrowed $80,000 and paid, say, $65,000 in interest, that's $145,000 principal and interest over 30 years, but paying it back with the declining instrument like the dollar at 7% inflation, you're only paying back $61,000 thereabouts in actual dollar value. So why the hell would you not leverage high, leverage long, and pay off slow? That's
Right.
what don't pay them off any faster. Ride that 30-year out as long as you possibly can. So the website that details inflation, Tim just put that up there. Go to shadowstats.com, and then and I pay the $100 a year to have the login. So when you go to Shadow Stats, you want to go to the top. You'll see along the top you'll see alternate data. Hover over alternate data until you see inflation. Click on inflation. There's another really sexy thing on there below that, the CPI calculator, where you can put in, what was $100 30 years ago. So if I put $100 in, what was the value of $100 back in 1980? Or excuse me, 1990. Holy crap! 30 years ago was 1990.
I know it sucks.
I have shoes that are older than that.
Dude, I know. I've got this. I've stumbled across some clothing that I think I still wear. So that's the benefit of trucker hats, man. They never go out of date, and being a rep, you can wear stuff for forever. So $100 today is equal to $8.38 in 1990.
Wow.
So flip that around. I was actually talking to an attorney yesterday. He said that when he had graduated college in 1989, his dad gave him $100. He was walking big with $100 in his pocket. It's like, well, let's go back and look at 1990. That'd be like me giving my son $1,193 today.
Mm-hmm.
Wow.
That's the gap. So when you think about paying this off over 30 years, that very last payment, that $405 a month payment, 30 years from now, it'd be like paying like $38. That's not going to be the cost of a latte.
That's right.
It's probably going to be a really small latte.
That's right.
Isn't that what it costs now?
Not even a grande.
And I think you can get two for that. It's amazing what we're willing to spend and sit in line for a cup of coffee.
Yes.
Get the packets and do it at home, guys.
I was getting ready to make a comment on that, but then I have this long diatribe I have to get into, and you only have so much time. So, how is business for you? Has the
underwriting changed for one?
Has it gotten tighter? I know you're really in tune with the secondary market as well. Are you seeing any issues there that we might be worried about?
There's a few things to talk about there. So the underwriting has changed on a general basis, just because a lot of people are still fearful of the real estate investor.
Mm-hmm.
Are we going to have another real estate bubble? Is that going to affect the investors? Are people buying too many houses? Well, that's because people don't understand the real estate investor. I've worked my ass off since 1997 to really understand the mindset of the real estate investor. And when you get that, and you, sorry about this. This is my Google thing for my sister. Google form for her to answer. Yeah, that now I'm going to get into it. Right? I'm doing answering service for the team. So that's what happens. I had to create an account just to get my license in Missouri for the office I built out there, which is my cabin and all that. So I won't even go. Sorry, I'm trying. So When it comes to the real estate investor and understanding that, Security National, the company I'm with right now, this firm gets it. Now, it's not like they got it overnight. It took them about 4 years to really start to really understand what I was bringing to the table with the real estate investor. And what it took was having a history of understanding those products. So we have an organization that's very heavy into the first-time home buyer, which in my opinion has always been the riskiest prospect for a bank.
Absolutely.
Money. Not only give them money, but you're going to finance the highest percentage possible of their new purchase with a track record of how they pay for that home. On top of that, many times you're going to give them their down payment or a portion of it, or some sort of benefit for being a first-time home buyer. What happens when things get remotely rocky for a person who's been used to getting stuff handed to them?
Oh yeah. Listen, besides that, these are people that have no idea ongoing maintenance for owning a home, never had to own a lawnmower, any of that kind of stuff.
Right.
And
they didn't know the cost of what it is to take care of this, right? So during the first couple of years I was here, we had this big audit happen. They were auditing everything that I was touching. And I'm like, guys, what's going on here? Why are we auditing all this stuff? And they said that, because there's some high risk to real estate investors. Like, well, let me ask you a question. We do a ton of first-time home buyer. Can you tell me what is the percentage of delinquencies in your portfolio, because they service a lot of their portfolio, on your first-time home buyers versus my investors? Like, well, it's a good question. Went back and looked, they were seeing close to double-digit percentage of delinquencies, not defaults, delinquencies, people that are making late payments.
Right.
And I asked them, go take a look at my portfolio. They were servicing right now, they're servicing like close to, my memory's telling me like 1,800 loans that I've written. And not counting the ones that were in forbearance. We were looking at, because there's forbearance with people with job losses. I get that. And that was literally like 30 or 38 people. But outside the forbearance, only one person with a late payment.
Wow.
So it goes to show you, it's like, wait a minute, it's not this big risk that we're talking about with real estate investors. So that they've embraced a lot better. So because of that, now we are really, really slammed with people buying real estate investments. And I've been blessed to build a business that has me all over the country. I mean, hell, I'm talking to you guys over there in the Carolinas right now, and I'm out in Arizona. I've got 25 staff members, and I have everybody from the initial phone call employed on my staff all the way to the funding. So underwriting, processing, funding, they're all on my staff. In fact, you'll see Scotty back here behind me. He's helping me on the phone call side deal with all the conversations that I have to have that I'm missing all the time, because I'm only one guy, and I can only talk to one person at a time and sound coherent. So and it's the same conversation. I should be able to just say, everybody, I'm going to be on Zoom for an hour today. Just jump on and we'll all talk together, because it's going to be the same end result. But people want that personal discussion. I get that. And as far as the guidelines themselves, we're not seeing a lot of difference for us. There's some little nuances, but it doesn't affect my investors much. There's a lot of nuances with conventional guidelines out there for conventional as a whole. The biggest thing that we've seen in the secondary market today is, well, one, the secondary market has been blessed with a massive flow of cash from the Fed. The Fed is dumping $40 billion a month into the mortgage-backed securities pools.
Wow.
It's absolutely insane. You go all the way back to 2008 when we had the crash, and you get to January 1, 2009, when the Fed started quantitative easing, dumping money into the market. They're doing $80+ billion a month, to the tune of about $1.25 trillion between January 1 of 2009 to the end of March 2010. So that to us was just massive numbers. Well, they did that between March 20th and March 30th. They did nearly that same amount of money.
Wow.
They dumped that much into the mortgage-backed securities to get interest rates back on track when the mortgage-backed securities pools dumped. And the only reason they really dumped that we could tell was when the stock market crashed, all the banks that were holding people's capital, they had it on deploy, right? Banks don't just take your money and stick it in a vault. They've got to do it somehow. Well, there was enough money out there in the market on margin that when those margin calls came in with that crash in March, they had to meet those calls. So when they met those calls, they had to sell assets. What assets did they sell? A lot of bonds, treasury, corporate bonds, and mortgage-backed securities. So that killed the interest rates overnight. And so that month of March was just tough until the Fed jumped in and dumped in that money. But they've continued to put it in there, currently at about $4 billion a day.
Wow.
$4 billion a day. I mean, try and wrap your head around this. So we've had trillions of dollars being dumped into the mortgage-backed securities pools. So in reality, the Federal Reserve is funding mortgages right now, is what's happening. So I don't know if that's a good thing or a bad thing. It kind of scares the shit out of me, if I want to be just blunt, that the Federal Reserve is the one who pretty much has been owning the mortgages for the last few months. And the amount of demand on the refis, people are refinancing like crazy. The industry as a whole can probably push about $2 trillion worth of loans per year through. We're getting that kind of demand in a 2-month window.
Yeah, I think that's just perpetuating the problem, because in the secondary market, they're paying above par for a loan. And for our audience, you don't buy a loan for what it's worth. You buy it, and the person that sells it to you has to make a little bit of a profit. And how do you make that profit back? Well, you get that over the next 4 to 5 years in payments. That's how you get that money back on that. But if everybody refinances every year, they're not making it. So they're not buying those things at par or even above par. They're buying them at less than par. So now you're having to sell at a discount. So I think as long as these rates keep continuing to go down, you're going to have the Fed going in there and buying them, because they're the only ones that are going to buy them at par.
And what you're talking about is the servicing side of the industry. Because what you've got is the mortgage-backed security itself that had up until this point, mostly it was like pension funds and people's 401ks and IRAs and mutual funds and all these things putting their money in there, and they were getting the note rate. So let's say the note rate today would be 2% for an owner occupied. They're getting 2% return on their investment. Well, then they're going to offer you, say, a 2.75% rate, because, like you said, those people in the middle got to make their money. The guys on Wall Street, the people writing the loan, all that kind of stuff. There's a margin in there. Well, then the servicing side of the industry, once the loan is written and done and packaged and Wall Street's taken it, somebody's got to collect the payments. So in traditionally, those who would buy it would buy $10 billion blocks and pay 1%, right? Well, that 1% is, let's say it's a $100,000 loan. They're paying $1,000 to get the rights to service that. Now, what do they get out of that? They get to keep maybe $300 a year of what they collect. Not very much. They may be collecting $1,000 a month on that, or not even $1,000 a month. They're going to collect probably $400 a month. They get to keep $300 a year what they collect. Well, like you said, it takes them about 4 years to break even when you consider overhead plus the initial expense. Well, that side of the industry came out in March and said, guys, we're no longer buying it. In fact, we know you Wall Street guys can't service it. We're the ones built for that. So you're not only going to give us the loan, you're going to pay us to take it. So now we're going to have 0.5% on that to take it. So they're getting paid to take the servicing. So now, they've worked it into the system where it's working. Now I'm starting to see a little bit more buying going on out there in the secondary market for servicing. Not as much still. There's still there's a little bit of a dynamic there as far as an additional margin in there to pay those guys to take the loan. So understand those who are getting loans, even though if you understood MBS, it's like, why is my rate not lower? Well, we got to pay people to service you, to make sure that that didn't sound right. So,
they should be so lucky.
we're not doing that kind of service. So we're gonna pay people to accept their payments and manage your account for you. Now, another interesting thing that's happened in the secondary market today is Fannie Mae came out last night. The FHFA, the Federal Housing Finance Administration came out. I think that's what it is. Too many damn letters in this business. They came out last night. It was after hours, and they tacked 0.5% onto everything.
Wow.
So that is, and they're tacking onto the refi world. And here's what I'm thinking. It's one of two things: either to slow it down because we're just getting inundated with refi requests, and when you start thinking about the cost to produce these transactions and wire that money out and do all the auditing in the background, they've got to either kind of try and slow it down a little bit. I don't think 0.5% on the price is going to do anything in reality. But then also have to consider they're paying people to do the servicing. And if what's happening is people are refinancing, I got people that called me up to refinance literally 6 months ago saying, hey, the rates went down a little more. Can I refi again? I'm like, yeah. You've paid $5,000 for that. Why do you want to do that again? But they're doing it because we have been trained.
Yeah.
We are a bunch of monkeys that when we hear the song, we start dancing. And it's the banking industry that's trained them. And the reason why they've been trained to do that is, what does the first 5 years of your amortization table look like?
It's all interest.
All interest. And if you can convince people to refinance every 4 years, what do you get?
Interest.
All interest, and they never knock down the principal. So you're literally getting, you at Carolina Capital would love it if you could hand somebody a loan and say, guess what, here you go. And then they just pay you interest and they pay you back your principal after a period of time. You make 12%. interest on an annual basis, plus you're always just getting your principal back, and you're never seeing people knocking it down and dragging that principal payment out over 30 years when you're getting with a declining instrument like the dollar. Of course, they want them to pay it back and refi every few years, right?
Yep.
But what it was is now, this is Aaron Chapman's belief. I could be completely wrong here, but now it's coming back to bite him in the ass, because now people are refinancing every 6 months. That doesn't play into the equation at all. But who is benefiting, in my opinion, is the people over on Wall Street who are doing these trades. It's a trade. It's no different than your stockbroker going out there and trading for you constantly, where you're making no money on your stock, but he's getting the fees every time he sells and buys, right? It's the same thing. Wall Street's able to make that trade and make money somewhere. There's money being made somewhere. And I really don't believe it's the person refinancing every 6 months. They're paying costs to do that. Somebody's making it, but it's also becoming back to bite people in the ass. And that's why we're going to up these margins.
Yeah, I just hope that your loan officers out there nationally make sure that they stay in touch with I know the refinance business is big right now, but make sure you stay in touch with your realtors, because eventually
refis will drop.
You're going to have to rely on purchase monies.
Well, there's those that have made their living off of refi all along, and they're never going to be purchase guys. I get it. We've been a purchase shop all along ever since, was it 1999. So I really decided I'm a purchase guy and start shaking my ass out there like I'm late on rent to get those deals. Rent's due all the time. Let me just tell you, it's constantly looming overhead. But you're right. They need to get out there and do that, or decide if you're a refi guy, then there's going to come a time soon you have to get out and find some other career, because the refis are going to dry up. And not only the refis are going to dry up, when the market catches up with where it should be, not only going to refis are going to dry up because people have already refied, right?
Right.
Businesses are going to dry up, because why would I buy a new house when I've got a $600,000 home now, right, at 2.5%? Why would I go buy something else when my interest rates can be 4 or 5 or 6 on an owner occupied?
Right.
That's why I've targeted the real estate investor as where I focus my energy at, and my education and understanding, and helping them be successful in their business. Because no matter what the market does, rents keep going up. Inflation drives rents up. No matter what the rates are doing, rents are still going up.
Right.
The real estate investor can still capitalize. There's still deals out there.
Yeah. Before you came on, Wendy and I were talking about precious metals versus income producing real estate, or cash flow in real estate, and which one was the best hedge. And we both, for the most part, stuck with real estate. Of course, we're biased.
Yeah, I like real estate, but I don't think it's an either or. I think you need to dabble in both.
Well, I do heavily dabble in one, which is one precious metal I think is probably the trump over everything out there investment. That's copper jacketed lead.
Really?
You never have too many bullets.
I get that.
Especially now, it's there's a shortage of it.
Yeah.
Exactly. Dude, there was a point when it was the most precious metal. I mean, it was going up faster than anything else out there.
Really?
Right? And when you consider what was going on during a certain window in the last 10 years, last 10 years, I mean, you couldn't get 22 rounds. I mean, something that was costing a couple pennies, you'd have to spend dollars to get your hands on. So in that respect, yes. And in a precious metal sense of it, it does have some huge value for the weight. Plus, look what you can do with that thing, right?
Yeah.
I mean, I don't know if you've noticed it's easy to notice how I'm dressed. If you think that I don't have any of that stuff, you're not looking.
So what do you think of gold and silver?
Man, it's something that I definitely agree a person should have. The problem that me personally that I run into is it's not just the acquisition of what you got to pay to get it.
Yeah.
Right? You pay so much to get your hands on it and be able, then you got to store it and all those kinds of things. And it's definitely something that's worth having. Then you have to break it down in certain ways so it is an actual tradable commodity. It's not necessarily something that you want stacking bars. What am I going to do with a bar?
Right.
It's really get to a point where it's a type of system where you're going to have to employ that into the market and be able to put it to use. I'm not going to trade a bar for a loaf of bread.
Right.
I mean, we don't know where the world's going to go, and that might be too much of an Armageddonist thought process to even consider. But if to get it into a broken down method to where it's actually usable in a day-to-day economy is the one thing that I would definitely want to caution people about, to be sure that whatever it is you do get, bars are cool, It's a cool thing to break out when the boys are talking about who's got the biggest utensil, but that's not something that's going to benefit you if you really need to use it.
You have to pull out the pocket knife and start taking little slices off.
Start shaving it, exactly, and then you got to keep the sharpener close because that knife ain't going to last very long.
Yeah. Then you're going to have to go buy scales, so you know how much it's worth.
How much of that bar do you have to shave off to buy your damn scale, right?
That's
right.
exactly right.
That's too
So
funny.
So I'm
what
definitely a fan of it, though.
what are you seeing on the commercial side of life? I know you're doing mostly single family, but what are you seeing on the commercial side?
Man, that's something that is definitely it's a scary thing to consider what's happening on the commercial side because we've changed human behavior with this COVID thing, right?
Yeah.
People are sheltering in place. People are living at home. They're working from home. I can imagine that the office side of things are really going to get hit pretty hard. The other thing, I worry about the multifamily because when you think about what we've got here, 2-bedroom, 1 bath with 2 kids trying to work from home and they're trying to school from home. There's still a lot of people that have now embraced homeschooling more so than they ever have in the past.
Right.
Or have an effect on what people would have rented that apartment building or that apartment, right? So the also thing you think about what's happening to our unemployment. Employment is definitely still bigger than what people I think are really understand.
Right.
And it's hard for a lot of us to see it because we still live in a world where we're doing very, very well. I'm very, very blessed. When I look around, I don't personally witness the unemployment that people are witnessing. My family's all in the medical side. I'm in this side of it. So the medicine side is doing very well. My wife's a nurse. My daughter's a nurse. My daughter's a tech over at the hospital where my wife is a nurse at. My son-in-law's in the military. My son is in shipping. So he works for FedEx. They're all very, very, very well employed at this point. So I'm not seeing the effects of that personally, but I know many are. So when you see what's going on there and you're living in an apartment and you got the guy next door that's been out of work for a certain length of time, what is going on in that shared wall, right? There's got to be some fighting. There's got to be some going on. There's things getting broken. You don't want to share a wall in a situation like that. So those who are in those scenarios are wanting to be in that single family residence. They want that gap between them and their neighbors. So your single family investor, I believe, will continue to feel the benefits of what our economy is creating and the habits of humans. But as a result of that, the commercial side of it, I'm afraid is probably it hasn't seen the full result yet. I think that result is at the point.
That's right. And I'm wondering what that is going to do. How is that going to topple over and affect the rest of the real estate world? How will that affect us?
Well,
it's hard to know. I think that if we want to understand how it's going to affect us, think about how humans are going to react to things. You're going to have to sit there and get your mind into a dark place for a minute to really put yourself where things are going to be, with our current trajectory and what that might look like. And then what does the individual have to do for the day-to-day to bread their table? And how is that going to affect where they do their work from? That's going to be the question. Well, maybe the commercial play is prisons. I don't know.
Well, I met a guy last weekend at Tom Olson's Good Success Mastermind, and his dad is highly educated, but he's driving for DoorDash, bringing home $8,000 a month. Wow. Driving for DoorDash. Now he's working 12-hour days, 6 days a week, but hey, that's not bad income, right?
No, that's well, yeah. And if you got a cheap enough car, that kind of thing, it's amazing how that is something we're seeing a lot more at my house. We're calling and having it delivered more often than we ever had. Right. Actually, we're having our groceries not really delivered. You pull up and they fill up the back end of your vehicle. We're not doing the shopping thing anymore. So human services are going to continue to grow, I think. People that are willing to perform work for another person. And I'm finding I'm doing that on a greater scale as well. My daughter was laid off from, she's 18. She was laid off from a bakery. And I got up one morning and I was realizing I was late to try to get to my next call because I was trying to make some breakfast so I at least get something in my belly before I started for the day. And I just kicked her out of bed and I was like, get out here. I said, are you back to working for the bakery? She goes, no, they haven't opened back up again. Like, how much did you make per month? She told me. I got my checkbook out. I wrote out a check for $200 more and I slid it to her. She goes, what's this for? I said, I'm never making breakfast again. Nor am I making lunch, nor am I making dinner. That's going to be waiting for me at these times. And this is the basic idea of what I want to be eating so I can eat healthy because I don't have time for that. So I've literally brought that part of the economy into my own household and it's helped me because I don't have time for it.
Yep.
And now you can charge your rent.
I haven't thought about that. Well, she's going to ask for a raise if that's the case. Interestingly, it will be the same dollar amount as rent, right?
That's right.
Well, things are just going to evolve. You probably heard that Amazon is in talk with Simon Properties, owns all the malls, and Amazon wants to take over the Sears and JCPenney spots in these malls. They're gonna start paying rent that they're not getting, which is good. They're probably going to add a smaller grocery component, but they're putting distribution or fulfillment centers inside of these. Most of these old Sears and
they're huge.
JCPenney parts of a mall are 2-story, so they need all those different levels.
But they got warehousing inside, even inside the space. So you have the space itself, which is retail, and then the warehousing behind it. So
right.
Amazing amount of space there. What I'm surprised they haven't done is they haven't made the second level like a retirement community. You got the bottom levels where they can all go shopping and do their thing. Why have they not done that yet?
Yeah, they can ride the escalator down, do the mall walk, and then back up to their house.
That's a great idea. We have a new business. That's awesome.
Yeah, Carolina Capital, you start buying the upper levels and turning that into a retirement community. Let the other people, let the Amazons of the world take over the bottom stuff, and then you guys can send them around. And you only have to give me 3% of that company for giving me.
That's right. That's a segment that is hurting right now, and I'm praying that it's short lived. But the senior living, assisted living communities, they've taken a hit because of the virus. But it's got to be short-lived. People aren't going to, take care of their parents for a long time. They're going to get tired of doing that. I know that sounds cold, but it's a fact, right?
Well, it's not a matter of tired of doing it. It's just, do they have the financial wherewithal to do it? Because the inflation and cost of living is screaming through the roof. And one of the things we're also not taking into account with cost of living is how many people inside your household are a draw on that dollar.
Right.
So, we're not looking at the fact that you have a compounded cost just because of inflation itself. Now you've added people to it. You've added children to it. Now you have that additional demand on that. Now your expenses are tripling, quadrupling, going up. Then you go and add in, your parent. Now we all should be willing to take care of parents. I'm going to be taking care of my pop and my mom. And in fact, I'm closing on a property tomorrow, so I can be able to have that wherewithal next door to do that because they're getting older, right? We got to be prepared to do that.
Right.
But not everybody's going to have that capability. It's a sad state of affairs. I'm thinking that we as a society might be going backwards just a little bit in our social structure of more of a family compound, if you will, having multiple members of the family there to help cover the cost of things. Because cover it all by yourself is tough.
Yeah, and that's a good thing. Although I would like to get rid of my teenagers.
Well, good luck on that. My dad says they come back and bring more.
Yeah. I know I did.
Yeah. Aaron,
for sure.
Thank you so much.
You're so full of it. I mean, information.
There's more there if you want to know about the other stuff I'm full of.
So, how can people get a hold of you, Aaron?
Website, aaronbchapman.com. AARON, B as in Bravo, not my middle name, CHAP as in Paul, MAN.com. And that will get you started.
Excellent. You're a wealth of knowledge as always. I appreciate your time. You're so kind to give us that time. I know you're just swamped.
Yes.
And you're connected with the right people, Bill, to get me on here.
Well, that's because I got Wendy as a sister. That's how I get it with the right folks. Anyway,
I appreciate you both, allowing me to come and take time with your folks, and I appreciate those who have been listening and asking questions.
Thank you.
Absolutely. Once again, thanks, folks. We appreciate it. If you want to know anything about us, carolinahardmoney.com. If you're a borrower, go to the borrower tab. If you're an investor looking for passive income, go to the investor tab. Don't forget to share, like, subscribe, all that stuff. And you guys can continue to add questions and comments into the chat space. Like I said earlier, we have someone that scours those things and we can answer those questions on an upcoming show.
Absolutely.
Right? So you guys have a wonderful day. We'll see you next week.